Your savings account is actually making you poorer every single day. With inflation at 6.4% last year and bank interest rates averaging under 1%, you're literally losing purchasing power by trying to be responsible with your money. This is just one of the 5 financial traps that wealthy people religiously avoid. In the next 12 minutes, I'll show you exactly how the rich protect and grow their wealth using strategies that almost nobody talks about, and how you can start doing the same thing today, regardless of your current bank balance. The hidden math that's stealing your money. Did you know your responsible financial habits might actually be your biggest wealth destroyer? Let's do the math together, because what's happening in your savings account might shock you. Remember how we were all taught growing up that saving money in a bank account is the responsible thing to do. Our parents, teachers, and probably every financial literacy course hammered this into our heads. Save your money in the bank where it's safe. It sounds like solid advice. Keep your money secure, earn some interest, and build a nest egg for the future. But here's where things get interesting. And by interesting, I mean potentially devastating for your financial future. When we actually crunch the numbers, a disturbing truth emerges. That savings account you've been faithfully feeding? It's actually a wealth destruction machine operating in plain sight. Let me show you exactly what I mean. If you had $10,000 sitting in a typical savings account 5 years ago, you'd think you're doing pretty well today, right? The bank statement shows your balance has grown to around $10,300 with interest. But that warm, fuzzy feeling of growth is a complete illusion. In reality, the purchasing power of your money has been silently eroding year after year. With inflation averaging around 3% annually over the past decade, and spiking much higher recently, that $10,000 from 5 years ago would need to be worth about $11,600 today just to buy the same amount of stuff. That means your responsible savings actually lost about $1,300 in real-world value. This isn't just some temporary problem or rare economic blip. The data consistently shows that cash has been one of the worst-performing assets across almost any 10-year period you can find. In fact, when we look at the long-term data, cash virtually always loses value over time when measured against inflation. Last year was particularly brutal with inflation hitting 6.4%, while the average savings account paid a laughable 0.06% interest. That's not a typo. That's literally less than 0.1%. Even the high-yield savings accounts were only paying around 0.5%. The math is painful. You were losing nearly 6% of your money's purchasing power just by being what society calls financially responsible. Think about that for a second. If you had $50,000 in savings last year, you effectively lost $3,000 in purchasing power. That's like someone taking $3,000 bills out of your wallet while you weren't looking. Except it happened with your full permission because you've been taught this is the safe approach to money management. The wealthy understand this dynamic intuitively. It's why you'll rarely find truly wealthy people with significant portions of their net worth sitting in savings accounts. They keep just enough cash for emergencies and immediate expenses, typically just 3 to 6 months of living expenses, and put everything else to work in assets that have at least a fighting chance of keeping pace with or beating inflation. What makes this wealth trap so insidious is that it masquerades as financial virtue. We're taught that saving money is always good, but we're never taught about the critical distinction between saving and investing. Your parents weren't being malicious when they taught you to save. They just didn't understand the math themselves. To make matters worse, our brains aren't wired to intuitively grasp the concept of compound inflation. We can see our bank balance going up by small amounts, but we don't see the invisible tax of inflation eating away at our purchasing power year after year. It's like watching a plant grow while being completely unaware that termites are hollowing it out from the inside. The wealth trap becomes even more pronounced during times of economic uncertainty. When markets get volatile, most people respond by moving more money to cash, thinking they're being safe. In reality, they're jumping from the frying pan of market volatility into the slow-cooking oven of guaranteed inflation loss. Consider what happens over longer time frames. If you maintain this safe approach for 20 to 30 years, the wealth destruction becomes catastrophic. A 30-year period with average inflation of just 3% will reduce your purchasing power by more than 60%. Your retirement savings could end up being worth less than half of what you thought you were accumulating. And inflation isn't always a steady 2 to 3% per year. We've seen periods where inflation spikes dramatically. The 1970s saw inflation rates above 10% for multiple years. More recently, after decades of relatively stable inflation, we've witnessed rates spiking above 6%. These inflation surges can rapidly accelerate the destruction of your savings. What's particularly interesting is how institutions benefit from this knowledge gap. Banks are more than happy to hold your money and pay you next to nothing while they turn around and invest those same funds for significantly higher returns. They're effectively arbitraging the difference between what they pay you and what they can earn elsewhere. So what's the first step to thinking like the wealthy? Stop treating your savings account as an investment vehicle. It's not. It's a temporary holding place for money that's waiting to be properly deployed. The wealthy use savings accounts like way stations, not final destinations for their capital. This doesn't mean you shouldn't have any money in the bank. Emergency funds are still crucial. Unexpected expenses happen to everyone. But anything beyond that 3 to 6 month cushion is actively working against your financial interests. Every single day it sits in a low interest account. What's even more eye-opening is comparing the long-term performance of cash versus other asset classes. Over the past century, while cash has consistently lost purchasing power to inflation, assets like stocks have generated average annual returns of around 7 to 10% after inflation. Real estate has typically delivered 1 to 4% above inflation. Even bonds, traditionally considered a conservative investment, have historically provided returns that at least keep pace with inflation. The difference between losing 2 to 3% per year to inflation and gaining 7 to 10% in growth investments creates a wealth gap that becomes astronomically wide over time. This is precisely why the gap between the wealthy and everyone else continues to expand. They're playing an entirely different game with fundamentally different rules. So the first wealth trap we need to avoid is the illusion that savings accounts build wealth. Mathematically, they guarantee you'll get poorer over time. While everyone else is patting themselves on the back for being responsible savers, your financial education starts with recognizing that the conventional wisdom about saving is fundamentally flawed. The single stock gambling addiction. If you thought savings accounts were a sneaky wealth destroyer, let me introduce you to an even more dangerous financial trap: individual stock picking. While everyone's friend has a story about making a fortune on Tesla or Bitcoin, there's something these success stories leave out entirely. The stock market can seem like a playground of opportunity, but here's the shocking truth. About 80% of individual stock pickers actually underperform the market over a 10-year period. That's right, 8 out of 10 people who spend hours researching the next big thing would have been better off doing almost nothing with their money. Let's be real. We've all felt that excitement when someone tells us about a stock that's guaranteed to explode. Our brains light up with visions of early retirement and yacht parties. It's almost like gambling, but we convince ourselves it's different because we're investing. But the math tells a completely different story. Take 2020, for example, a year many people jumped into the market hoping to strike it rich. While the S&P 500 index returned an impressive 18.4%, did you know that 203 stocks within that index actually lost money? And we're not talking small losses. 10 stocks within the S&P 500 lost at least 47.9% of their value. Imagine putting your life savings into what you thought was a safe blue-chip stock, only to watch half of it disappear. Remember Enron? It was once considered one of America's most innovative companies. Its stock price soared to $90.75 per share in mid-2000. Investors couldn't get enough. Financial experts recommended it. By the end of November 2001, less than $1 per share. Complete collapse. Thousands of people lost their retirement savings practically overnight. But that's just one example, you might say. I'm smarter than that. Here's where psychology plays a devastating role in our financial decisions. We suffer from what experts call recency bias, giving too much weight to recent events and assuming current trends will continue indefinitely. When we see a stock going up for weeks or months, our brains trick us into believing it will keep rising forever. This psychological trap is nearly impossible to overcome without strict systems in place. Another mental trap that destroys wealth is overconfidence bias. Most of us genuinely believe we're above average at picking stocks. We convince ourselves we have special insight or information. This overconfidence leads to excessive risk-taking and poor investment outcomes. The reality Even the professionals can't beat the market consistently. Studies show that most professional fund managers, people who spend their entire careers analyzing stocks with teams of researchers and sophisticated tools, still can't consistently outperform the market. Let that sink in. If the pros with all their resources can't reliably pick winning stocks, what chance does the average person have spending a few hours on research after work? The wealthy understand this mathematical reality on a deep level. They rarely gamble their wealth on individual stocks because they recognize concentrated positions for what they truly are: unnecessary risk without compensating reward. When they do invest in individual companies, they approach it completely differently than most people. First, wealthy investors follow strict criteria. They don't buy based on hype or what's trending on social media. They look at fundamental valuation metrics, competitive advantages, and management quality. They consider position sizing, never putting too much of their wealth in a single company, no matter how promising it seems. Second, they understand the brutal math of stock returns. During the decade ending in 2020, approximately 40% of U.S.-listed stocks produced negative returns. Think about that. Nearly half of all companies actually lost money for their investors over a 10-year period. Meanwhile, only 0.4% of domestic equity mutual funds lost value during the same period. The power of diversification isn't just a theory, it's mathematical reality. Warren Buffett, arguably the most successful investor of all time, consistently emphasizes the importance of diversification over individual stock selection. He has explicitly stated that diversification is essential to mitigate risk, and that investors should focus on a broad portfolio rather than trying to pick individual winners. When one of the greatest stock pickers in history tells everyday investors not to pick individual stocks, perhaps we should listen. Financial expert Larry Swedroe puts it bluntly: investing in individual stocks is more akin to speculating than investing. You're taking on uncompensated risk that can be diversified away through a well-constructed portfolio. It's like going to Vegas and playing roulette when there's another game next door that offers better odds. The mathematical reality is stark. A long-term, diversified investment strategy beats single stock picking 89% of the time. This is why wealthy investors prioritize asset allocation over attempting to find the next big winner. They understand that how you divide your investments among different asset classes, stocks, bonds, real estate, etc., matters far more than which specific stocks you pick. Remember those 203 stocks in the S&P 500 that lost money in 2020 while the index gained 18.4%? If you had owned the entire index through a simple, low-cost index fund, you would have captured that 18.4% gain regardless of which individual company stumbled. This is the power of diversification. Your winners more than make up for your losers. The wealthy also recognize something that most stock pickers miss. You don't need to find the next Amazon to build wealth. Consider this. If you had invested in a simple S&P 500 index fund 30 years ago and reinvested all dividends, you would have multiplied your money several times over. No stock research required. No stress about quarterly earnings reports. No need to constantly check your portfolio. Think about the emotional toll of individual stock picking too. When you put a significant portion of your wealth into a single company, every news headline becomes a potential threat. A CEO resigns, your stock drops 15%. A new competitor enters the market, another 10% gone. A quarter of slightly disappointing earnings? Watch your investment crater. This constant emotional roller coaster doesn't just affect your mental health. It leads to poor decision-making that further damages your returns. The wealthy avoid this trap entirely. They build diversified portfolios designed to weather any economic storm. They don't need to be right about every company. They just need to be right about broader economic trends. This approach isn't just less stressful. It's mathematically superior based on decades of financial research. When you look at the actual data, individual stock picking looks less like investing and more like a casino where the odds are stacked against you. The stock market overall has created enormous wealth over time, but individual companies come and go with alarming frequency. By betting big on individual stocks, you're taking on enormous risk without a corresponding increase in expected returns. The exact opposite of what smart investing should be. The emotional investor's self-sabotage cycle. While picking individual stocks is a mathematical gamble, There's a more devious force working against your financial success, and it's happening inside your own brain. That survival wiring that kept your ancestors alive is actively sabotaging your investments every time the market fluctuates. Wall Street professionals know this so well that they actually use your fear as their profit signal. Let's be honest, we all think we're rational when it comes to money. We believe we analyze facts, weigh options, and make smart decisions based on logic. But neuroscience reveals something far more troubling. Your brain is literally divided against itself when you invest. When you're checking your portfolio, two distinct brain regions battle for control. Your prefrontal cortex, the rational, analytical part, tries to make sensible decisions. But lurking beneath is your limbic system, the emotional, reactive part that's programmed for survival, not wealth building. And guess which one typically wins during market volatility? That's right, your emotional brain hijacks the controls precisely when cool-headed decisions matter most. This internal conflict creates a devastating performance gap. Research shows the average investor underperforms the market by a staggering 30 to 50% due to emotional decision-making. Think about that. You could be losing nearly half your potential returns not because of poor investment selection, but because your brain's wiring works against you during crucial moments. The emotional cycle of investing follows a predictable pattern that wealthy investors have learned to recognize and avoid. It starts with optimism as markets rise steadily. This gradually transforms into excitement as your investments grow. Then comes euphoria when everything seems to be skyrocketing. The dangerous point where your brain floods with dopamine and you start making increasingly risky decisions. But markets inevitably correct or crash. That's when anxiety creeps in, followed quickly by denial. It's just temporary. Then fear and finally panic, the point where most investors capitulate and sell everything. And here's the cruel irony. This panic selling typically happens right before markets begin to recover. This emotional cycle is so predictable that professional investors actually use retail investor sentiment as a contrarian indicator. When everyday investors are panicking and selling, the professionals are often buying. When retail investors are euphoric and piling in, professionals are quietly taking profits. They've learned to do the opposite of what emotions suggest because they understand this destructive pattern. Loss aversion makes this cycle even more damaging. Psychological research shows we feel the pain of losses about twice as intensely as the pleasure of equivalent gains. This creates a devastating tendency to hold on to losing investments too long, hoping they'll recover, while selling winners too early, fearing they'll decline. Both behaviors systematically destroy wealth over time. Let me share something that initially shocked me when studying behavioral finance. During the 2008 financial crisis, as the market plummeted nearly 40%, retail investors pulled a staggering $150 billion from equity mutual funds. But where did that money go? Much of it sat in cash until after the market had already recovered substantially. The emotional drive to escape pain caused millions to lock in their losses permanently and miss the subsequent recovery. Wealthy investors handle this problem differently. They recognize their emotional vulnerabilities and implement structural guardrails to protect themselves from their own psychology. These aren't just mindset tricks, they're concrete systems that remove human emotion from the equation. The first guardrail is automatic investment scheduling. By setting up regular, predetermined investments regardless of market conditions, wealthy investors sidestep the emotional tendency to invest more during market highs when everyone feels confident, and less during market lows when fear prevails. This approach, called dollar-cost averaging, transforms market volatility from an emotional trigger into a mathematical advantage. The second guardrail involves predefined sell criteria established during calm periods. Before buying any investment, wealthy investors determine exactly what would cause them to sell. Specific price targets, fundamental business changes, or portfolio allocation limits. This prevents the common emotional trap of changing your investment thesis during market turmoil. Some wealthy investors take even more dramatic steps to avoid emotional sabotage. They deliberately structure their financial lives to minimize exposure to market noise, checking portfolios quarterly rather than daily. Others hire financial advisors whose primary value isn't picking investments, but preventing emotional mistakes during market volatility. The advisor serves as an emotional circuit breaker, stepping between the investor and potentially destructive impulses. What's fascinating is how these safeguards create a virtuous cycle. By protecting yourself from emotional decision-making, you not only improve returns but also experience less anxiety. The wealthy understand that investment peace of mind doesn't come from finding safe investments. It comes from building systems that protect you from yourself. Consider two investors who started with identical portfolios in 2008. Investor A, driven by emotion, panicked and sold most holdings during the crash, then waited until 2010 to reinvest after markets had substantially recovered. Investor B had automatic investment guardrails in place and actually increased contributions during the market bottom. By 2012, Investor B had nearly twice the portfolio value of Investor A, not because of superior investment selection, but simply by avoiding emotional sabotage. This pattern repeats across every market cycle. During the March 2020 COVID crash, retail investors pulled over $326 billion from equity funds in a single month. Meanwhile, institutional investors with emotional guardrails in place were buying aggressively at discounted prices. When markets rebounded to new highs just months later, guess who benefited most? The neurological explanation is fascinating. When markets plunge, your brain's amygdala, the fear center, activates as if you're facing a physical threat. This triggers a cascade of stress hormones that literally impair your prefrontal cortex's ability to make rational decisions. You become physiologically incapable of clear thinking precisely when clear thinking matters most. But by implementing automatic investment systems and predefined criteria, you essentially transfer decision-making authority from your emotional present self to your rational past self. Your investments continue executing a the portfolio construction blueprint. Riding the inflation wave is just one part of the wealth-building equation. The truly shocking revelation? Most wealthy people don't spend their time picking winning stocks at all. Instead, they follow a mathematical framework for portfolio construction that almost guarantees long-term success. And it looks nothing like what financial influencers are telling you to do. Let me pull back the curtain on how the truly wealthy actually build their investment portfolios. While we're constantly bombarded with hot stock tips and get-rich-quick schemes on social media, high-net-worth individuals are quietly following a completely different playbook, one based on mathematical principles rather than hunches or emotions. The secret weapon of the wealthy isn't some exclusive stock pick. It's their asset allocation formula. High-net-worth individuals typically structure their investments using a diversified model that spreads their money across equities, fixed income, real estate, and alternative investments. This isn't random. It's strategically designed to optimize their risk/return profile. One of the most common frameworks wealthy investors use is the classic 60-40 split. 60% in stocks for growth potential and 40% in bonds for stability. This isn't flashy or exciting, but it has consistently delivered solid risk-adjusted returns through various market cycles. The wealthy understand that boring often equals profitable in the investing world. Family offices, which manage money for ultra-wealthy families, often take a more aggressive approach, with allocations of up to 80% in equities, particularly focusing on growth sectors. But notice they still maintain that smaller percentage in fixed income and alternatives to hedge against market volatility. Even when being aggressive, they never abandon their diversification principles. University endowments offer another blueprint worth studying. These institutional investors typically allocate 30 to 50% to equities, 20 to 30% to fixed income, 10 to 20% to real assets like real estate, and 10 to 20% to alternative investments such as hedge funds or private equity. This balanced approach has allowed endowments like Yale's and Harvard's to generate impressive returns over decades, not just quarters. The wealthy understand a concept most retail investors have never heard of, the efficient frontier. This mathematical model from modern portfolio theory illustrates the optimal portfolio allocation that delivers the highest expected return for a given level of risk. Smart investors aim to construct portfolios that sit on this frontier, maximizing returns while minimizing unnecessary risk. Here's what makes this approach so powerful. It's about the relationship between assets, not just the assets themselves. When a wealthy investor adds a new investment to their portfolio, they're not just asking, will this make money? They're asking, how will this interact with everything else I own? This holistic view creates a portfolio where the whole truly is greater than the sum of its parts. Age and financial goals play a crucial role in how wealthy individuals allocate their assets. A young investor with decades until retirement might start with 80% in equities and 20% in bonds, gradually shifting to a more conservative mix of 60% equities and 40% bonds as they age and their risk tolerance decreases. The formula evolves with their life circumstances, not with market predictions. What's especially fascinating is how the wealthy maintain discipline through market cycles. When the market drops, most retail investors panic and sell. The wealthy, they rebalance. Studies show that optimal rebalancing strategies involve adjusting asset allocations periodically, typically annually or when asset classes significantly deviate from their target weights. This systematic approach forces you to buy low and sell high, exactly the opposite of what emotional investors do. The proof is in the performance. Diversified portfolios consistently outperform concentrated ones during economic downturns. Different asset classes react differently to market conditions, providing a buffer against volatility. When stocks are crashing, other portions of a well-constructed portfolio may be holding steady or even gaining, cushioning the overall impact. To implement this yourself, start by determining your own target allocation based on your age, goals, and risk tolerance. A simple starting point might be the age-based rule. Subtract your age from 110, and that's roughly the percentage you might consider allocating to stocks, with the remainder in bonds and other assets. But remember, this is just a starting point. Your specific situation may call for adjustments. Once you've established your target allocation, commit to it through market cycles. This means having the discipline to rebalance when market movements throw your percentages out of whack. If your target is 70% stocks and 30% bonds, but but a market. Run-up has pushed your portfolio to 80% stocks and 20% bonds. You'd sell some stocks and buy bonds to get back to your target. For most people, implementing this approach is simpler than you might think. You don't need fancy software or a finance degree. Index funds and ETFs make it easy to get broad exposure to different asset classes without picking individual securities. A handful of broad-based funds can give you the diversification that wealthy investors spend millions to achieve. The beauty of this systematic approach is that it removes much of the guesswork and emotion from investing. You're no longer trying to time the market or pick the next Amazon. Instead, you're harnessing the long-term power of diversified growth across multiple asset classes. The same strategy that has built generational wealth for centuries. Building your emotional investment guardrails. A well-designed portfolio is just half the battle. Your brain is actually wired to sabotage your investments during market extremes. The wealthy have figured out how to bypass their own psychology with something called investment policy statements. And the difference in returns between investors who use them and those who don't is absolutely staggering. Let's be honest, we all like to think we're rational when it comes to money. But here's the uncomfortable truth. Knowing about emotional biases isn't nearly enough to overcome them when markets are crashing and your portfolio is bleeding money. That's why wealthy investors don't rely on willpower or good intentions. They build systems that make it physically impossible to act on those destructive impulses. Think about it like this. You wouldn't try to diet by filling your pantry with cookies and hoping for the best. You'd remove the temptation entirely. That's exactly what savvy investors do with their portfolios. They create guardrails that prevent emotional decisions before temptation strikes. The cornerstone of this approach is something called an investment policy statement, or IPS. This isn't just some boring document. It's the single most powerful tool wealthy investors use to protect themselves from their own psychology. An IPS is essentially a written contract with yourself that clearly defines your investment goals, strategies, and most importantly, the exact conditions under which you'll buy, sell, or hold investments. What makes an IPS so effective is that it transforms vague intentions into concrete rules. Instead of saying, "I'll stay invested during market downturns," your IPS might state, "If the market drops by 20%, I will invest an additional $10,000 from my cash reserves according to my target allocation." This removes all decision-making during emotionally charged moments. The power of an IPS was dramatically demonstrated during the 2008 financial crisis. Investors who had established clear guidelines before the crash were able to follow their predetermined plans rather than panic selling at the bottom. Those who adhered to their IPS not only preserved their wealth, but often enhanced it by systematically buying assets at depressed prices, exactly when everyone else was fleeing the market. Another powerful emotional guardrail wealthy investors employ is dollar-cost averaging DCA. This strategy involves investing a fixed amount of money at regular intervals, regardless of what the market is doing. The beauty of DCA isn't just mathematical, it's psychological. By automating your investments to occur on specific dates, you completely bypass the temptation to time the market. Studies consistently show that DCA often outperforms lump sum investing, especially in volatile markets. This isn't just because you're buying more shares when prices are low and fewer when they're high. It's because you're removing emotion from the equation entirely. When the market plunges, your automated system keeps buying while others are panic selling. When everyone's celebrating bull markets, your system prevents you from pouring in too much cash at peak prices. Many wealthy investors take emotional protection a step further by creating decision-making frameworks that prioritize logic over gut feelings. These frameworks might include specific criteria for evaluating investment opportunities, predefined price targets, or technical analysis indicators that trigger buying or selling actions. The key is that these decisions are made dispassionately, based on predetermined criteria, rather than how you feel about the market on any given day. For example, a rules-based investment system might dictate that you must sell a stock if it falls below a certain percentage from its peak price. This prevents the common problem of holding on to losing positions due to emotional attachment or the sunk cost fallacy. Similarly, you might establish specific criteria for buying new investments, such as valuation metrics or fundamental indicators, preventing impulsive purchases based on hype or FOMO. Some of the Wealthiest investors literally remove themselves from the decision-making process by hiring financial advisors. But not for the reason you might think. While professional expertise certainly matters, the primary value these advisors provide is serving as emotional circuit breakers. Their job is often to protect clients from their worst impulses during market extremes. Think of these advisors as accountability partners who can provide objective feedback when emotions are running high. During times of market volatility, having someone who can calmly remind you of your long-term goals and prevent reactionary decisions can be worth their weight in gold. This support becomes crucial when everyone around you is panicking, as it encourages you to stick to your strategy rather than following the herd. Mindfulness practices have also emerged as powerful psychological techniques for overcoming emotional biases in financial decision-making. By becoming more aware of your emotional triggers, you can recognize when fear or greed is influencing your thinking and take a step back before making any moves. This emotional awareness allows you to assess market situations more rationally, particularly during volatile periods. Let me share a practical example of how these emotional guardrails work together. Imagine you've set up an IPS that includes a target allocation of 70% stocks and 30% bonds, with quarterly rebalancing. When the market dropped dramatically in March 2020, your portfolio might have shifted to 60% stocks and 40% bonds as stock values fell. Your IPS would have triggered a rebalancing, requiring you to sell bonds and buy stocks, exactly when your emotions would have been screaming to do the opposite. This automatic rebalancing forces you to buy low and sell high, the fundamental principle of successful investing that emotions typically prevent. And by having this decision predetermined, you avoid the paralysis that affects so many investors during market turbulence. Rules-based systems can be even more sophisticated for those with larger portfolios. Some wealthy investors establish tiered investment approaches where different portions of their portfolio follow distinct strategies with clear triggers for action. For instance, a core portfolio might follow a passive, long-term approach while a smaller portion is managed more actively with specific buy-sell criteria. What's particularly powerful about emotional guardrails is that they work regardless of your portfolio size. Whether you're investing $10,000 or $10 million, the same psychological principles apply. The key is creating systems that protect you from yourself before you need that protection. The true diversification matrix. Systems can protect you from emotional decisions, but what happens when your supposedly diversified portfolio suddenly moves in lockstep during a market crash? There's a mathematical tool the wealthy use to see connections between investments that remain invisible to average investors, and it completely transforms how you should think about spreading your risk. Most people think diversification just means owning a bunch of different investments. They'll proudly tell you about their portfolio of 20 different ETFs, or how they own stocks across multiple sectors. But here's the thing, when markets get chaotic, these seemingly different investments often crash together, leaving investors shocked as their diverse portfolio nosedives all at once. This happens because true diversification isn't about quantity, it's about mathematical relationships. And this is where correlation matrices come in. A correlation matrix is essentially a table that shows how different investments move in relation to each other. Wealthy investors use this tool religiously, and for good reason. Let me break this down in practical terms. When two investments have a correlation of 1.0, they move perfectly in sync, both up 5% one day, both down 3% the next. A correlation of 0 means they move completely independently of each other. And a negative correlation? That's the holy grail. When one investment goes up, the other tends to go down. I recently analyzed a client's portfolio who thought they were well diversified because they owned 15 different mutual funds. When we mapped out the correlation matrix, we discovered something shocking. Almost every fund had a correlation above 0.8 with the others. In other words, their diversified portfolio was essentially 15 variations of the same investment. This is why wealthy investors approach diversification completely differently. They're not just asking, what do I own? But rather, how do these investments behave in relation to each other? Let's look at some real-world examples of how this plays out. Imagine a traditional 60-40 portfolio of stocks and bonds. During normal market conditions, these asset classes often have a low or even negative correlation. Bonds might rise when stocks fall. But during the 2008 financial crisis, many high-quality corporate bonds started moving in the same direction as stocks, catching investors by surprise who thought they were protected. This is why sophisticated investors go beyond just stocks and bonds. They incorporate investments across different dimensions of the market that respond to different economic forces. For instance, certain commodity investments have historically shown negative correlations with traditional stock markets during inflationary periods. While your stock portfolio might struggle when inflation spikes, these commodities could potentially offset some of those losses. Another example is real estate investment trusts, REITs, which often respond differently to economic conditions than broad market indices. While tech stocks might soar during periods of innovation and growth, REITs might outperform during stable economic periods with moderate inflation. The wealthy also understand that geographic diversification matters tremendously. U.S. markets and international markets don't always move in lockstep. When the U.S. faces economic challenges, emerging markets or European stocks might be in a completely different cycle. But here's where it gets really interesting, and where the wealthy leave average investors in the dust. They don't just diversify across asset classes and geographies. They diversify across economic sensitivity factors. What do I mean by that? Some investments perform well during economic expansion, others during contraction. Some thrive with rising interest rates, others with falling rates. Some benefit from a strong dollar, others from a weak dollar. By constructing a portfolio with assets that respond differently to these economic factors, you create true diversification. Let me show you what this looks like in practice. Imagine you're building a portfolio with 4 key components. First, a core of broad market equities that capture economic growth and innovation. Second, a selection of fixed income investments that provide stability and income while potentially moving independently from stocks. Third, real assets like REITs and commodities that often serve as inflation hedges and respond to different economic forces than paper assets. And fourth, alternative investments with low correlations to traditional markets. Things like market-neutral hedge fund strategies or private equity. When combined properly, these elements create a portfolio that's genuinely resilient across market cycles. Not because you own many different things, but because you own things that respond differently to economic conditions. Let's get even more specific about what this might look like. Consider how institutional investors and family offices construct their portfolios. They might include equities across different market capitalizations, from large cap to small cap companies, stocks with different factor exposures, value, growth, quality, momentum. Bonds across the yield curve and credit spectrum, real estate investments across residential, commercial, and industrial sectors, commodities that respond differently to economic cycles. Alternative investments with unique return profiles. The key is understanding how each component interacts with the others. That's why correlation matrices are so powerful. They make these invisible relationships visible. I remember working with a client who had what appeared to be a diverse portfolio of technology stocks, energy companies, healthcare firms, and financial services. But when we ran the correlation matrix, we discovered his supposedly diverse portfolio had a weighted average correlation of 0.85, almost moving in complete unison. We restructured his investments to include assets with correlations closer to 0.3 or lower with each other, dramatically improving his risk-adjusted returns. Now, you might be thinking, this sounds complicated. Do I really need to build correlation matrices to invest successfully? The good news is that you don't have to become a mathematician to apply these principles. There are straightforward ways to implement true diversification. Instead of focusing solely on owning different stocks or funds, concentrate on owning investments that serve different roles in your portfolio. Some for growth, some for stability, some for inflation protection, and some for crisis protection. Pay attention to how your investments have historically performed during different market environments. Did they all tank together in the last downturn? That's a red flag that you might not be as diversified as you think. Consider adding asset classes specifically chosen for their low correlation to the rest of your portfolio. This might mean venturing beyond just stocks and bonds to include REITs, commodities, or alternative investments. The beautiful thing about proper diversification is that it doesn't just reduce risk, it can actually improve your returns over time. That's because a truly diversified portfolio allows you to maintain exposure to growth assets while managing downside risk, letting you stay invested through market cycles rather than panic selling at the bottom. The wealth acceleration timeline. That proper diversification isn't just about risk reduction. It's the foundation for exponential wealth growth over time. Let me show you what happens when you combine all 5 wealthy investor strategies we've discussed into one comprehensive approach. Ever wondered exactly how much money these 5 strategies could put in your pocket? The numbers are so dramatic, they might seem impossible until you understand the mathematics behind them. Let's explore what your financial future could look like if you implemented all these changes starting today. Imagine 2 investors, both starting with $10,000. Investor A falls into all the common traps, keeping too much cash, chasing trendy stocks, making emotional decisions, failing to properly diversify, and jumping from one investment trend to another. Investor B implements the wealthy strategies we've discussed, investing early to harness compound interest, maintaining proper diversification, using emotional guardrails, and focusing on time-tested strategies rather than trends. The first major difference emerges through the power of compound interest combined with early action. When you start investing in your 20s versus your 30s, the impact is staggering. That single dollar invested at age 20 can grow to $5.84 by age 65 at just a 4% annual return, while waiting until age 30 reduces that growth to just $3.95. This isn't just a small difference. It's nearly 50% more wealth simply by starting a decade earlier. The difference gets even more dramatic when you look at consistent contributions. Take a young investor putting just $200 monthly into a retirement account. With an average 7% annual return, they could accumulate over $100,000 by retirement. This highlights why wealthy investors prioritize early and consistent investing. They understand the exponential growth curve of compound interest. But what about fees and investment choices? This is where the gap between wealthy and average investors really widens. Let's examine what happens when someone avoids high-fee investment products and focuses on low-cost options instead. A young investor who chooses low-cost index funds over actively managed funds with high expense ratios could save tens of thousands in fees over a 30-year period. These savings aren't just sitting idle. They're being reinvested and compounding, creating a snowball effect that leads to a substantially larger retirement fund. Now let's visualize the impact of annual returns. Even a seemingly tiny 1% difference in annual performance creates a massive wealth gap over time. An initial $10,000 investment growing at 6% annually versus 7% results in a difference exceeding $60,000 after 30 years. That's 6 times your original investment just from an additional 1% return. When we combine all 5 wealth strategies, the results become truly eye-opening. Investors who avoid the 5 traps we've covered can potentially have 2 to 3 times more wealth after just 20 years compared to those making these common mistakes. And remember, this doesn't require a huge starting investment or specialized knowledge. It simply requires following the principles we've discussed. Let me walk you through a practical example. 2 friends, both 30 years old, each have $10,000 to invest. The first friend keeps too much in cash, panic sells during market drops, chases trendy investments, maintains poor diversification, and constantly switches strategies. The second friend implements all our wealthy investor strategies. Minimal cash holdings, proper diversification across uncorrelated assets, emotional guardrails to prevent panic selling, and a consistent time-tested approach. After 20 years, the first friend might have grown their portfolio to around $20,000 to $25,000, barely keeping ahead of inflation. The second friend, however, could reasonably expect to have $50,000 to $75,000 or more from the same starting point. The difference isn't about initial wealth. It's about the approach to growing that wealth. Dollar cost averaging plays a crucial role in this success. By consistently investing regardless of market conditions, the second investor takes advantage of market downturns to buy more shares at lower prices. This strategy has been proven to mitigate the risks of market timing and can lead to better long-term outcomes compared to trying to invest lump sums at the perfect time. Look at the research on emotional investing. Investors who maintain a disciplined approach and avoid emotional reactions significantly enhance their portfolio performance. This isn't a small enhancement either. Studies indicate that avoiding panic selling during market downturns alone can dramatically improve long-term returns. While the average investor might sell during a crash, and miss the eventual recovery, disciplined investors actually increase their contributions during these periods, purchasing assets at discounted prices. True diversification creates another multiplier effect. Investors with diversified portfolios across various asset classes experience less volatility and better returns compared to those heavily invested in a single sector. When markets crashed in 2008 and 2020, properly diversified investors were able to rebalance their portfolios, selling assets that held value to buy others at discount prices, a strategy that accelerated their recovery. The math becomes even more compelling when you factor in the advantage of starting early. Those who begin implementing these strategies in their 20s or 30s can potentially retire decades earlier than those who don't. It's not about having a high income. It's about consistently applying these principles regardless of your starting point. What's most encouraging is that these strategies work regardless of your current financial situation. Whether you're starting with $1,000 or $100,000, the principles remain the same. The wealthy don't have access to secret investment vehicles. They simply follow these mathematical principles consistently over time. Here's the truth most people miss. Building wealth isn't about having more money to start with. It's about making fundamentally different decisions with whatever money you currently have. As our research shows, financial planning and investing aren't exclusive to the rich. 62% of adults own stock, and over 53% own mutual funds. This means the tools for wealth creation are already within your reach. The 5 traps we've covered aren't just theoretical concepts. They're the real barriers standing between you and financial freedom. By implementing the strategies wealthy people use, you're positioning yourself to benefit from compound growth rather than fighting against it. Remember, wealth isn't built overnight. But by consistently avoiding these 5 traps, you're already ahead of most investors. The best part, you can start today with whatever you have.